Have you ever watched a stock rise dramatically on seemingly no news, only to be left wondering how some traders seemed to know the move was coming before it happened? What if I told you there's a hidden dimension to price charts that reveals the true intentions of smart money, days or even weeks before major price movements occur? When most traders look at their charts, they focus almost exclusively on price action. The candlesticks, support and resistance levels, and various technical indicators. But there's a second dimension that exists alongside price that most traders overlook, despite it being displayed on virtually every chart platform in existence. I'm talking about volume, the silent narrator that reveals what's really happening beneath the surface of the market. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Richard Wyckoff, one of the most influential traders of the early 20th century, understood something profound about markets that most modern traders still miss today. He saw that price alone tells only half the story. It shows what happened but fails to explain the force or intent behind the movement. Has this ever happened to you? You see a perfect technical setup. Everything looks textbook, but then the trade falls apart unexpectedly. That disconnect often happens when traders ignore the critical message that volume is sending. Volume is the fuel that drives all significant price moves. It represents the actual energy, intensity, and conviction behind every market action. To ignore volume is like reading a novel by looking only at the pictures. You miss the rich and revealing narrative contained in the text. At the very core of Wyckoff's methodology lies his third fundamental law, the law of effort versus result. This powerful concept states that for every action in the market, there is a reaction, and the nature of that reaction can tell you a great deal about the underlying balance of power. In this relationship, volume represents the effort, while price movement demonstrates the result. Stay with me until the end of this video, because what you're about to discover might fundamentally change how you analyze any market. When effort and result are in harmony, such as rising prices on expanding volume, the market is confirming its direction. But what's truly fascinating is when they fall into disharmony, when significant effort produces little result. These divergences provide some of the most reliable early warning signals in all of technical analysis. The relationship between price and volume isn't merely a correlation. It's a window into the mind of what Wyckoff called the composite man, the representation of all smart money. In the market, volume reveals this operator's hand, showing when they are accumulating or distributing positions, often right under the noses of unsuspecting retail traders. What if you could learn to spot these footprints before the big moves happen? In the next few minutes, I'm going to show you how to decode the secret language of volume. If you found this analysis valuable, hit the subscribe button to join our community of technical traders who see beyond price action. In the world of market analysis, there's a hidden truth that separates the consistently profitable from those who struggle. Understanding the relationship between harmony and disharmony in price and volume. This relationship is the secret language the market speaks to those willing to listen. Think of harmony as that perfect synchronization when volume confirms what price is telling us. When a stock advances on expanding volume, we're witnessing a beautiful alignment. The effort, volume, justifies the result. Price movement. This confirmation isn't just technical validation, it's a revelation about the underlying strength of buying demand. The market is showing its hand, revealing its true intentions through this perfect harmony. But the most powerful signals, The ones that can transform your trading journey come from moments of disharmony. This occurs when effort and result fall out of sync with each other. Imagine a stock that's been climbing steadily, suddenly experiences a day of enormous volume, yet the price barely moves higher or even closes lower. This divergence isn't just a technical anomaly. It's a window into the behind-the-scenes reality of what's really happening. This disharmony is the market's early warning system. When significant effort produces minimal results, we're witnessing a powerful shift in the balance of supply and demand. It's like watching pressure build in a system before a dramatic change occurs. These divergences often precede major reversals, giving the astute observer a critical edge in decision-making before the majority realizes what's happening. Now, I want to go even deeper into this topic by exploring what volume truly represents in its essence. At its core, volume is the purest measure of supply and demand dynamics in any market. High volume doesn't just indicate activity, it signifies significant disagreement about a stock's true value. It proves that large operators, what Wyckoff called the composite man, are actively participating. This is crucial to understand because these institutional players cannot accumulate or distribute large positions without trading in enormous quantities. Their footprints are impossible to hide completely. When volume surges, it's often a signal that smart money is making significant moves. They're either building positions they believe will be profitable or unloading positions they believe will decline. Equally revealing is when volume dries up. Low volume or dullness isn't just absence, it's presence of a different kind. Sometimes it indicates genuine lack of interest, but often it represents a deliberate strategy by large operators to discourage public participation. They create this dullness on purpose, making the stock appear boring while they quietly accumulate shares before the next significant move. The mindset shift comes when you stop seeing markets as random and start recognizing these patterns of harmony and disharmony, supply and demand. You begin to understand the impact of volume, not just as a technical indicator, but as the physical manifestation of actual buying and selling pressure. Let me know in the comments if you've ever noticed a stock that moved dramatically after a period of unusually high or low volume by writing, "I've seen this pattern." I'm curious how many of you have already observed these volume signals without realizing their significance. To truly master the art of reading volume, we need to journey behind the scenes to understand a technique that Wyckoff himself considered essential: tape reading. In Wyckoff's era, traders would analyze the character of volume as it printed moment by moment on the stock ticker tape. This wasn't just about the total volume for the day, but about understanding the subtle texture and quality of that volume throughout the trading session. The true revelation comes when you realize that not all volume is created equal. Wyckoff understood that the size of individual trades revealed powerful clues about who was acting in the market. Large lots, trades of 1,000, 5,000, or even 10,000 shares, were almost always the footprints of the composite man, the professional operators. The average retail trader simply doesn't have the capital to trade in such sizes. These large blocks on the tape provide a direct window into the actions of smart money. Imagine watching a stock declining, and suddenly you see several large blocks being purchased at the bid price, absorbing the selling pressure. This isn't random, it's a deliberate accumulation strategy. Conversely, if a stock is rallying and you notice large blocks consistently being offered for sale, capping every advance while the buying is predominantly in small lots from an excited public, you're witnessing distribution in real time. The mindset transformation comes when you begin to distinguish between informed professional action and uninformed public reaction. Even in today's digital markets, this principle remains are powerful. Modern platforms may not show the ticker tape, but they do provide time and sales data, order flow, and volume profile tools that serve the same purpose, revealing the character of the volume, not just its quantity. This brings us to one of the most misunderstood, yet opportunity-rich volume signatures in the market, the selling climax. At market bottoms, after a prolonged decline has exhausted most buyers and negative sentiment reaches extreme levels, we often witness a dramatic event, a day of exceptionally wide price range, accompanied by an explosive surge in volume. To the untrained eye, this massive volume on a day of sharp decline looks terrifyingly bearish. The natural emotional response is fear, leading many to sell at precisely the wrong moment. But the trained Wyckoff analyst sees something entirely different, a massive transfer of ownership from weak, fearful hands into strong, patient, well-informed hands. This is the paradox that creates opportunity. For every share sold, there must be a buyer. The immense volume of a selling climax isn't just panic selling, it's equally powerful buying. The composite man uses public fear as his opportunity to acquire shares at bargain prices. The high volume represents tremendous effort, and the result is that the price stops declining, often closing well off the lows of the day. These climactic moments represent significant turning points, but they're disguised as chaos. They're the market's way of testing your conviction and emotional resilience. If you can recognize a selling climax for what it truly is, the exhaustion of selling pressure rather than its confirmation, you gain a tremendous edge that few traders ever develop. If you've ever sold in panic near a market bottom, only to watch prices recover shortly after, type, "I've learned this lesson the hard way," in the comments. These painful experiences often become our greatest teachers on the market journey. After witnessing a selling climax, the next critical revelation in the Wyckoff journey comes with what's called the secondary test. This event occurs when price drifts back down to retest the low established during the climax, and its volume signature is absolutely crucial for confirmation. For the secondary test to be valid, it must occur on volume that is a mere fraction of what was seen during the climax itself. This dramatic shrinkage of volume is the hidden truth that selling pressure has been exhausted. It confirms that the panic is over, that fear no longer dominates the market psychology. When you see this pattern unfold, a climactic high-volume decline followed by a retest on significantly lower volume, you're witnessing one of the most reliable bottoming formations in all of technical analysis. Throughout the entire accumulation phase that follows, this same principle applies. The most important bullish volume signature during accumulation is the gradual drying up of supply on reactions. On each swing down toward support, volume should progressively lighten. Wyckoff emphasized that dullness after a decline is actually a sign of strength, counterintuitive as that might seem to most traders. This pattern creates the heartbeat rhythm of healthy accumulation, expanding volume on rallies and contracting volume on reactions. It's the market's way of telling you that demand is quietly but persistently gaining control, that the composite operator is successfully absorbing the floating supply. Behind the scenes, a transformation is occurring in the ownership structure from weak hands to strong. As the accumulation campaign nears its end, we often see one of the most fascinating manipulative events in all of market behavior, the spring or shakeout. The spring is a sharp thrust below the support of the trading range, designed to mislead the public and trigger their stop-loss orders. It's at this precise moment that volume reveals its most powerful insights. A spring that occurs on conspicuously low volume is one of the most bullish signals possible. The price breaks support, where one would expect to trigger a wave of stop-loss selling, but instead finds a vacuum. The lack of selling pressure is definitive proof that supply is exhausted. The stock has been so thoroughly accumulated that there's simply no one left to sell, even at prices below the established support. Equally telling is a spring on high volume that quickly reverses. In this case, the break below. Support does trigger significant selling, but the price refuses to continue lower and rapidly returns to the trading range. This shows that the composite operator was present with buying power great enough to absorb this final wave of selling. It's the last gasp of supply being consumed by demand. These springs represent the final cleansing of weak hands before a significant advance can begin. They're the ultimate test of supply, designed to ensure that the stock is ready for markup. When you learn to recognize these volume signatures, you gain insight into market manipulation tactics that most traders never see. If you've ever been shaken out of a position right before it made a significant move in your originally anticipated direction, type "I've been sprung" in the comments. Recognizing these tactics is the first step to avoiding becoming their victim. After the long process of accumulation and the final spring that confirms supply exhaustion, the market finally reaches the moment many traders eagerly await, the breakout. What Wyckoff colorfully called the jump across the creek is that decisive move above the resistance of the trading range, signaling the beginning of the markup phase. But here's where many traders make a critical error in judgment. They focus solely on the price action of the breakout while ignoring its volume signature. The truth is that volume confirmation for a breakout isn't optional. It's absolutely non-negotiable. A genuine, valid breakout must be accompanied by a substantial and sustained increase in volume. This is the direct application of the law of effort versus result that we discussed earlier. The breakout represents a significant result, and it requires significant effort in the form of high volume to be considered legitimate. Ready to master the language of volume? Subscribe now and get access to our complete library of market analysis videos. This surge in volume reveals multiple layers of market psychology, converging at once. It shows that the composite operator is no longer accumulating quietly, but is now willing to bid the price up aggressively. It represents the recognition from other professional traders who see the technical signal. And it includes the forced buying from short sellers who suddenly find themselves trapped on the wrong side of the move. This confluence of demand creates the power needed to overcome the natural supply that exists at resistance. What's particularly illuminating is what happens when a breakout occurs on low or average volume. Despite what conventional technical analysis might suggest, such a move is highly suspect. It reveals a lack of conviction and suggests there simply isn't enough demand to sustain the advance. These low-volume breakouts often become bull traps, deceptive moves designed to lure in unsuspecting traders before quickly reversing course. Following a genuine breakout, we typically see a pullback to test the old resistance level as new. Support, what Wyckoff called the backup to the edge of the creek. The volume signature here is equally critical. A successful test must occur on dramatically shrinking volume, proving that the supply that was previously present at this level has been removed and sellers are no longer a threat. This low-volume test offers one of the safest entry points for those who missed the initial breakout. The journey doesn't end with a successful breakout. Once the markup phase begins, the stock should establish a rhythm, a pattern of higher highs and higher lows that defines a healthy uptrend. Volume plays a crucial role in confirming the sustainability of this advance. A strong, reliable uptrend has a very specific volume signature. Volume should expand on rallies and contract on reactions. As the stock pushes to new highs, expanding volume shows that buying enthusiasm remains strong and that demand is easily overcoming any profit-taking. When the inevitable pullbacks occur, contracting Volume proves that the selling is merely passive profit-taking from weaker hands rather than aggressive distribution from the composite operator. This creates a revelation for patient investors. As long as this harmonious rhythm between price and volume continues, there's a strong logical foundation for holding positions and allowing profits to run. If you've ever exited a position too early during what turned out to be a sustained uptrend, type "I left money on the table" in the comments. Understanding this rhythm of healthy trends can help overcome the psychological barriers that lead to premature exits. Just as markets create bottoming structures through accumulation, they also form topping patterns through a process called distribution. This is where the symmetry of market cycles reveals itself in fascinating ways. The first dramatic warning sign of a major market top is what's known as the buying climax, the mirror image of the selling climax we discussed earlier. The buying climax occurs at the end of a long, often accelerated advance when public enthusiasm has reached a fever pitch. The news is universally positive, social media is buzzing with success stories, and the fear of missing out drives the last wave of uninformed buyers into the market in a final, frenzied rush. It's precisely this moment of maximum optimism that the composite man has been patiently waiting for. After quietly accumulating at much lower prices, he now meets this euphoric demand with an overwhelming wave of supply. He feeds his enormous line of stock into the eager hands of the public, who believe prices can only continue higher. On a chart, this event appears as a day of extremely wide price range, accompanied by climactic, often record-breaking volume. What makes this pattern so revealing is that the price typically surges to a new high early in the session, but then stalls and closes well off the peak. This represents the ultimate disharmony between effort and result. The tremendous effort, climactic volume, has failed to produce a corresponding result, a strong close. This failure to hold gains is irrefutable evidence that the buying demand, as powerful as it was, met and was overcome by an even more powerful wave of selling supply. This event marks a profound shift in market psychology, the first revelation that buying power may be exhausting itself. Yet to the untrained eye, the enormous volume on a day that made a new high often appears bullish rather than bearish. The public interpretation is precisely opposite to the reality of what's occurring behind the scenes. Following the buying climax and the subsequent automatic reaction, the initial sharp decline, the stock enters its distribution range. The journey through this range is marked by volume signatures that are the direct inverse of those seen during accumulation. The most important sign of a distribution top is that volume expands on declines within the trading range and contracts on rallies. Exactly opposite to the healthy accumulation pattern, an increase in volume on sharp reactions within the range shows that supply is becoming aggressive. When the stock attempts to rally back toward the highs, the volume becomes conspicuously light. This drying up of volume on rallies is a critical warning sign. It proves there's a lack of genuine professional demand. The buying power has been exhausted, and the public lacks the financial capacity to absorb the large blocks of stock being offered by informed interests. Perhaps the most telling signature is the repeated failure of the stock to make significant upward progress despite high volume. The price may churn and show great activity near the top of the range, but it fails to advance higher. This churning action with high volume but no upward progress is the very definition of distribution, the effort-result disharmony that signals a major shift in the balance of power. If you've ever watched a stock or the overall market struggle to make new highs despite seemingly positive news and high trading volume, comment, "I've witnessed distribution" below. These patterns appear in markets of all types and timeframes. As the distribution campaign nears its completion, the composite man often employs one final deceptive maneuver to extract maximum profit, the upthrust. This is the bearish mirror image of the spring we discussed earlier. While a spring is a false breakdown designed to shake out weak holders, an upthrust is a false breakout engineered to trap the last remaining bulls and lure in new buyers at precisely the wrong moment. The upthrust appears as a sharp price move above the resistance line of the trading range that is specifically designed to fail. Its purpose is to create a final illusion of strength, encouraging breakout buyers to jump in while triggering the stops of any remaining short sellers. This burst of artificial demand provides the composite operator with the perfect opportunity to sell the last of his holdings at optimal prices before the decline begins. The volume signature on an upthrust provides the critical clue to its true nature. An upthrust on suspiciously low volume is a clear warning sign of weakness. It shows there's no genuine demand behind the breakout attempt. Even more revealing is an upthrust on high, even climactic volume that fails to produce any further upward progress. This represents one of the most powerful signs of distribution, showing that even an enormous effort couldn't produce a sustainable result. The confirmation of the upthrust comes with the price's swift failure to hold its gains, quickly falling back into the trading range. This confirmed failure offers one of the most reliable signals to exit all long positions and potentially initiate short positions in anticipation of the new downtrend. It's a strategic revelation about the market's true direction that most traders miss entirely. Once distribution is complete and ownership has transferred primarily to uninformed hands, the path of least resistance becomes definitively downward. The markdown phase begins with the breakdown, what Wyckoff called falling through the ice. The volume signature on this initial break of support is absolutely critical for confirmation. A valid breakdown must be accompanied by a significant and sustained increase in volume. This shows that sellers are aggressive and that there's powerful force behind the new downtrend. The expanding volume provides the necessary effort to produce the result of prices falling below long-established support. A breakdown attempt on low volume, however, is highly suspect and may simply be another shakeout rather than the beginning of a major decline. After the initial breakdown, there's often a rally back to the underside of the old support line, which now acts as new resistance. Wyckoff called this the last point of supply, LPSY, and it's one of the most dangerous points in the entire market cycle for those unaware of its significance. The volume behavior during this rally provides the final confirmation of the breakdown's validity. A test of the broken support on light, diminishing volume is an extraordinarily bearish sign. It proves that buying power has been exhausted and that demand is simply not strong enough to push the price back into its old trading range. This awareness of volume patterns throughout the distribution process and subsequent breakdown provides traders with an invaluable truth-finding mechanism, the ability to see through market deception and identify major turning points long before the majority of participants. If you've ever spotted a false breakout or been trapped by one, drop a comment saying, "I've survived an upthrust." These experiences, while painful, build the market intuition that eventually leads to consistent profitability. Once a downtrend is firmly established following a valid breakdown, understanding its rhythm becomes critical for both traders with short positions and those waiting patiently for the eventual bottom. Just as uptrends have a specific volume signature that confirms their health, downtrends possess their own rhythmic pattern that reveals their strength and sustainability. A healthy, sustainable downtrend exhibits a very specific relationship between price and volume. Volume should expand on the declines and contract on the rallies. This is the mirror image of what we see in healthy uptrends. When the stock makes new lows, the expanding volume confirms that selling pressure remains dominant and that supply is easily overwhelming any support that might emerge. This harmony between falling price and rising volume provides confirmation that the trend remains technically strong. On the subsequent rallies or relief bounces, the volume should noticeably shrink. These feeble, low-volume rallies are a powerful insight into market psychology. They reveal an absence of significant buying demand. The dwindling volume proves that there's no meaningful support to impede the downtrend's progression. These anemic rallies represent nothing more than temporary pauses in the larger markdown phase, rather than significant turning points. The careful observation of this volume rhythm provides both short sellers and potential future buyers with crucial decision-making intelligence. For those with short positions, as long as this harmonious pattern continues, expanding volume on declines and contracting volume on rallies, there's a strong logical foundation to maintain those positions and let profits run. For those waiting to buy, this pattern confirms that the time for accumulation has not yet arrived, that patience remains the wisest approach. The first meaningful deviation from this rhythm often provides the earliest warning that the downtrend may be nearing its end, that the next phase of accumulation could be approaching. This awareness allows the perceptive trader to begin preparing for the eventual cycle of renewal. Now, I want to go even deeper into this topic by exploring the profound transformation that occurs when a trader truly masters the art of volume analysis. Volume is the ultimate verification tool for price action. While price tells you what happened, volume reveals the story of the force and conviction behind the move. The genius of Richard Wyckoff was his systematic approach to reading this force through the lens of effort versus result. He understood that a price move without the confirmation of appropriate volume is often a deception, a manipulative maneuver rather than a true representation of the dominant power in the market. Conversely, a move supported by a harmonious volume signature reveals the authentic balance of supply and demand. By mastering these principles, by learning to read the climaxes, the tests, the breakouts and breakdowns through this perspective, the trader begins to see the market as the composite operator sees it. They develop the ability to detect the quiet, methodical work of accumulation and the noisy, obvious signs of distribution. They learn to perceive the hidden logic behind every significant market move, and to align their own actions with the dominant force, whether bullish or bearish. This journey toward mastery isn't merely about technical analysis. It's about developing market intuition, about training your mind to see beyond the obvious and into the subtle realities that govern price movement. It's about recognizing that markets aren't random, but rather follow logical patterns created by the endless interplay between professional operators and the public. If you've had that moment of clarity where suddenly a market move made perfect sense because of the volume pattern that preceded it, type "I've seen behind the curtain" in the comments. It's that moment when price and volume finally speak to you in a language you understand. As we've journeyed through the secret language of volume together, I hope you've begun to see the markets in a new light. Volume isn't just a secondary indicator. It's the force that drives all significant price movement. It reveals the hidden truth behind every advance and decline, every accumulation and distribution phase. The ability to read this language gives you an edge that most traders never develop. The ability to see the market through the eyes of the composite operator. This approach to market analysis isn't just about technical patterns. It's about developing market intuition and understanding the psychology that drives prices. When you learn to interpret the relationship between price and volume through the lens of effort versus result, you're no longer just following the crowd. You're anticipating moves before they happen, recognizing the footprints of smart money as they quietly build positions or methodically distribute them. If you found value in this perspective on volume analysis, I'd really appreciate it if you'd hit the like button. It helps others discover this content who might benefit from it too. And if you're not already subscribed, consider joining our community of thoughtful traders and investors who are focused on understanding markets at a deeper level rather than following the latest fads. I'm curious, which of these volume patterns have you already noticed in your own trading without realizing their significance? Drop a comment with "I speak" in volume now if this approach to market analysis resonated with you. Your insights and experiences add tremendous value to our community. There's a video right here that builds on what we've discussed today, exploring how to identify the specific price patterns that often accompany these volume signatures. Click and continue with me over there to complete your understanding of the Wyckoff methodology and take your market analysis to the next level.